Okay, let's dive right in. What we want to talk today about is Secure 2.0. And at the end of 2022, President Biden signed what's called the Year-End Omnibus Consolidated Appropriations Act of 2023. And as part of that law, the Secure 2.0 Act of 2022, what we'll call Secure 2.0, was enacted. It is really, it can't be overstated how significant and sweeping and comprehensive this legislation is. It addresses a very long list of issues concerning tax advantage retirement savings, including via 401k plans and other employer-based retirement plans. I think it's fair to say that it's the most consequential legislation concerning 401k plans since ERISA, which is a whole field, frankly, of law and a whole field of study. Now, given its recent enactment and, frankly, the size of it, proper understanding, full implementation is going to require interpretation and guidance from the IRS, the Department of Labor, and to my mind, ultimately the courts. And to date, that sort of interpretation and guidance has been limited. We are starting to see some. In 2023, for example, the IRS issued a number of notices bearing on Secure 2.0, including addressing catch-up contributions and some fairly specific issues concerning what are called RMDs. We'll touch on some of this as we proceed, but very generally speaking, and as we would expect, the theme of these notices and the guidance to date is that plan sponsors, and plan sponsors essentially refers to your veterinary practice in this instance. If you have a 401k plan, you are the plan sponsor. And providers like us, we're being given more time, a little more direction to try to basically catch up with the complexity of this law. Now, even though we have some guidance, the law is incredibly new. And I think Allyson and I always say that nobody's an expert at it yet. Nobody fully understands this law, not even us. And if anyone tells you they do, I would really question that. So as we will mention more than once today, your veterinary practice in connection with your 401k should proceed carefully and in good faith to understand this law, to get your arms around it a little bit, and to implement any mandatory or advantageous changes to your 401k plan. And for nearly all veterinary practices, that really means the first, second, third, fourth, and fifth steps should be communicating with your retirement plan service provider or providers if you have more than one to discuss and determine what you need to do next. So we're going to say that over and over today, communicate early and often, because this really is massive legislation. As you see on the screen, it contains 92 provisions. I actually read through the legislation. If I remember right, it's about 450 pages. So it's really significant stuff. And we don't have nearly enough time to cover all of it today or to address all of the nooks and crannies associated with the law. So we're going to try and hit some of the high notes and some of the items we think might be of interest and have the most applicability to your veterinary practice and your plan. Brief notice, you all know this already, but this is not legal advice. We're not your lawyers. I don't practice law anymore. And if you have a legal problem, you should consult your lawyers. That makes sense. We've organized the presentation by effective date. So now we're going to start with what is effective already. These will be as of the enactment of the law or already in 2023. And the first item we're going to talk about is RMDs, required minimum distribution. As a little background, RMD rules are basically there to ensure that retirement accounts are used for their intended purpose by making retirement account holders draw down their retirement savings upon reaching a certain age. So your required minimum distribution is the mandatory minimum amount you've got to withdraw from your 401k account and some other tax advantage accounts like some IRAs each year once you reach a certain age. And there is a formula for calculating it. It involves your account balances and something called the IRS's Uniform Lifetime Table. But in the end, I think you can look online for calculators, but really you should work with tax professionals or other experts to help determine your RMDs. Now, prior to Secure 2.0, pre-January 1st, 2020, required minimum distributions had to begin at age 70 and a half. And then between that and there was a law called Secure 1.0. And so from January 1st, 2020 until December 31st, 2022, RMDs had to begin at 72 years old. And as you can see here, per section 107 of Secure 2.0, the age for RMDs has been increased already to 73 years old and will increase again in 2033 to 75 years old. Again, the purpose here is that at some point you're going to have to start withdrawing from your retirement accounts, but the adjustments are being made essentially to account for increased life expectancy and to account for Americans who are living and working longer than ever before. And generally speaking, this is a positive for folks that are involved with their 401k plan because it allows your retirement savings to grow in a tax advantage way for another year. And if you're looking out further on the horizon, another few years, which is a positive thing. There was some guidance issued in connection with RMDs. I'm not going to dive too deeply into it, but in short, much of it, like we said earlier, was designed to allow providers and plan sponsors like your veterinary practice to adjust to these new rules. And it provides relief and what I think we can fairly call a grace period to those who could not fully adjust some of their systems or processes in time. And it also addresses some other issues. And as we keep saying, and as we'll say again and again, communicate with your providers about this issue. Communicate with your providers about how they're handling the new RMD age rules and how that's going to be addressed within your plans. The next slide also pertains to RMDs. And this one's important because while RMD ages are going up, penalties for failing to take RMDs are going down. And that's a positive. And this is per section 302 of Secure 2.0. Essentially, the penalty has been reduced from a 50% tax to a 25% tax on the undistributed portion of an RMD. In other words, any amount you were required to take, but you didn't take. So the shortfall, if you didn't take it all, it's all of it. If you didn't take a certain portion, that's what we call the shortfall, as you see on the slide. In addition to that fairly substantial reduction in the penalty, Secure 2.0 also reduces the penalty down to 10% for taxpayers who take the RMD or additional RMD, if you had a shortfall, and amend their tax returns before one of two things happens. A, an IRS audit, or B, the second year after the year the penalty is imposed, whichever comes first. And the headline there is, if you, as it says on the slide, if you catch the error and you correct it in a prompt and timely manner, then the regulatory authorities understand and are willing to give you a little grace and reduce your penalty even further. So again, that's a real positive, frankly, with RMDs, that if you do have a problem, if you do make a mistake, the penalty is going to be reduced greatly, particularly if you find the error and you get it corrected. Next, another item effective in 2023, small financial incentives. Section 113 of Secure 2.0 allows small, immediate financial incentives to be provided for contributing to a plan, for joining the plan or increasing your contributions. These, as you see in the slide, were previously prohibited, and the only financial incentives allowed were matching and profit sharing that can be built into 401k plans. But those are pretty long-term propositions. Those aren't incentives that people get the sugar rush immediately. That's kind of forward thinking, those incentives. So now this law is designed to allow you to provide what they term de minimis, small financial incentives for joining and contributing to the plan. Like with a lot of this stuff, there are a couple rules. They cannot be paid for with plan assets. And what we think is, think along the lines of gift cards, right? Small items, and use common sense and good faith in the amounts. So for example, with some of our plans, including some of our veterinary practices, and in collaboration with those practices, we'll sometimes offer $10, $20, $25 gift cards to anyone that joins the plan or increases their contributions within a certain time period. And this works. As silly as it sounds, that small sugar rush incentive can get people to act in a way that is really beneficial for their future selves. Indeed, there are a number of behavioral finance studies, and I'm not going to go into the details of them, but they show essentially that immediate item, that immediate $10, $20, $25 can really get people to act in a way that they might not otherwise do. It can get people to contribute and increase their contributions and really help themselves out in the long term. So this also, it seems like a small thing, pardon the pun, but it is extremely helpful, and it does make a big difference in terms of getting people to participate in plans. This one's for Allyson.
Yep, I'll jump in here and I'll comment on the last slide too. You know, before we legally could offer incentives like that to plan participants, at TrustPoint, we used to, and we still do a lot of in-person presentations, but we bring 100 grand bars and we incentivize participants to talk during the presentations by letting them know that whoever speaks up in a meeting will get 100 grand. So that works too. You'd be surprised at how those little incentives will push people to act in a certain way. So if you guys ever need that for your, vet staff meetings or whatever, I recommend that approach. In terms of hardships, that's the next slide. So hardships are a feature of 401k plans. And what I mean by that is a plan does not have to offer the ability for participants to take hardship distribution. So that's a decision that's made at a company by company, plan by plan level. So what a hardship distribution is it's truly a taxable distribution that an employee would take out of their 401k for some very specific IRS defined criteria of a hardship. Things like purchase of a primary residence, medical bills, funeral expenses, those sorts of predefined categories. So in the past, you as the employer were responsible for obtaining and maintaining copies of proof that an employee who took a hardship distribution actually had that need. And so, this would often come up in 401k plan audits. You'd be asked for proof that the employee had a hardship situation. They wanted to audit to make sure that you weren't being discriminatory and allowing one employee to take one and not another. It just put a lot of the liability on you as the employer and sponsoring the 401k plan. That has since changed. So now the onus is on the employee to maintain that proof. All they need to do, if your plan offers hardships, is self-certify that their need falls under one of those predefined categories, and then they're able to take those funds. They then would become subject to an individual tax audit instead of the plan being subject to an audit with regards to the proof required that they had a hardship situation. So it's really taking a lot of that liability off of the plan sponsor and putting that onto the individual participant instead. So we think that's a good thing. Anytime that there's less of a burden of liability on a plan sponsor, that's always a positive. It just, again, kind of streamlines that administration. The next, again, this change is also effective for 2023, and we think that this is a really good change. So for those of you who may be involved in distributing annual notices to plan participants or working with a company that does that distribution, in which case you would have to pay for the amount of notices that go out, that requirement is changing. So in the past, employers had to send out notices to anyone who was eligible for the plan, even if they weren't participating, and then anyone with a balance in the plan, including former employees who still had a balance. So that is now changing to just include employees who have a balance in the plan and former employees with a balance. So people who are enrolled or eligible but not enrolled are no longer required to get those notices. They just have to get a general annual reminder that the plan exists and that they're eligible for it. We think that this is a great thing. It's a busy time of year right before year end, usually when employers are having to track all those employees who are eligible. When it's employees with a balance, they can just run a list right out of usually the record keeping software, so they know where to send that to. Or for those who are working with a company that sends those notices out, it will likely go to fewer people, so it'll be a reduced cost going forward. So we definitely think that that is a positive change effective this year again.
And now we're going to start to look at some stuff that's coming down the pipe. We're going to look at stuff that will be effective in 2024. This next one has to deal with some of those distributions that Allyson mentioned a couple slides ago. In very short, current law does not allow emergency distributions from a 401k, except generally speaking for specific identified hardships, like Allyson was talking about moments ago. But Section 115 of Secure 2.0 is essentially creating a personal emergency distribution mechanism. And the quote is for, quote, unforeseeable or immediate financial needs relating to personal or family emergency expenses. So that is much more general than prior law allowed. And the idea essentially is to allow some limited emergent access to funds within the plan, basically to create an emergency fund or emergency fund type access for people. And if you know anything about financial planning, having an emergency fund is financial planning 101. And if you don't, I'm sure you've heard it too. And the idea here too is also to fit into that category of reducing burden on plan sponsors, your practice, the employer side, regarding whether someone does or doesn't fit into a particular category for a hardship distribution. So this is a real positive too, and it allows people to be involved with the plan, put money into the plan, and have comfort that in an emergency, at least, they're going to be able to get out some amount of money, $1,000. Now, there are some rules around these distributions. As you can see on the screen, the rules allow one penalty-free withdrawal of up to $1,000 per year. It may be repaid within 3 years. It doesn't have to be repaid. That's not required as part of these rules. But if you don't repay it, then you can't take any more similar emergency distributions for 3 years, right? So you either repay it, in which case you immediately have entitlement to do this again, or you don't repay it, and then you have to wait 3 years before you can do this again. And per some of the other slides, a participant can self-certify that there is this sort of personal emergency. And that's a positive on the employer side because, again, you don't have to track it. You don't have to get confrontational. You don't have to discuss whether or not this fits. The participant can tell you, hey, I'm self-certifying that I have this kind of emergency and I'd like access to these funds. So we view this one as a real positive as well, coming back down the pipe in pretty short order now in 2024.
And I'll jump in here too. I mean, you'll find as we continue to talk about some of these provisions, a lot of them without some technological advances in payroll and record keeping software will require manual tracking, which we don't think is, the best way to track these sorts of things, obviously. So we anticipate that, again, some of these provisions will get bumped out to allow even the software providers time to catch up to figure out ways to track these sorts of things in the system.
Yeah, absolutely. The next one, effective 2024, this is Section 304 of Secure 2.0. The headline here is that the upper limit of accounts that can be unilaterally distributed is being moved from $5,000 to $7,000. And so essentially, in your 401k today, you are allowed, when someone is separated from the practice and terminates employment, and they have an account balance of under $5,000, you are allowed to unilaterally, as the employer, close that account and distribute the funds. And there are some rules around how that distribution takes place, as you see on the screen. Balances can be, some low balances can be distributed directly to the participant. Others must be put into an IRA. But here, the change, what's happening with Secure 2.0 is that that upper limit of account value that can be distributed in this way, and thus the participant removed from your 401k plan, excuse me, is going to be moving from $5,000 to $7,000. This is also positive. It eliminates unnecessary administrative burden on plans by reducing the number of people that aren't currently employed in your practice who are in the plan. And it may also have an impact on cost, because most plan providers, including us, charge certain fees based on the number of plan participants. So if you have a whole mess of small account balances, you're being charged to maintain those accounts by your provider. And if those folks have left your employ, you might as well discharge them, so you and the other plan participants are not carrying that load and carrying those fees. So it's an easy win. And if it's not something you're attuned to, it's something you should raise with your plan providers to make sure that A, it's happening or you're being offered the discharge now, and B, that they're attuned to this raising limit and see how they plan to handle that. Next, we've got some more RMD related changes. Two of them. The first is in section 327 of Secure 2.0. It allows the surviving spouse to elect to be treated as a deceased spouse for RMD purposes. So what that essentially means is, if you have two spouses and one is the beneficiary on the other spouse's 401k account, and spouse A passes away, and spouse B inherits that 401k account, that surviving spouse can elect to be treated as the deceased spouse for RMDs. And the easiest example is if the surviving spouse is older than the deceased spouse, the deceased employee, and is the beneficiary on that 401k account, then the surviving older spouse can delay RMDs until the deceased employee, the deceased spouse, would have begun taking them. And that's a positive, because essentially it allows that surviving spouse to leave that money in a tax advantage account, to let it grow for a longer period of time until such time as the younger deceased spouse would have had to start taking RMDs. So then the second item noted on the slide, and this is section 325 of Secure 2.0, 401k plan participants must currently take what we call pre-death RMDs from 401k and 403b accounts. And that is different than what happens with Roth IRAs. Roth IRAs, you don't need to take pre-death RMDs from Roth IRA accounts, but currently in Roth 401k and 403b accounts, you do. And so the idea here is to bring Roth 401ks in line with Roth IRAs in terms of RMD requirements. And it makes sense for a lot of reasons, not least of which is what happens right now is that you have a Roth 401k, and to eliminate the pre-death RMD requirements, you roll it into a Roth IRA. So the idea here is simply to eliminate the need for that practice, the need for sort of that two-step, and to allow you in a Roth 401k to leave that money alone and not have to take RMDs. very briefly, just because remember, for a Roth 401k account, you've already paid taxes on that money. You paid taxes when you earned it, unlike a pre-tax account where you pay taxes when you withdraw it. So the idea here is we're going to let you grow that money a little bit longer and bring that rule in line with the Roth IRA rule.
We have been getting a lot of questions on this particular provision of the law. I'm sure, well, I certainly had student loans. I'm sure many of you did as well. So imagine if you had started your first job, you were still making student loan repayments, and you were able to receive the company match in the 401k without actually having to contribute to the 401k, but instead based on what you paid back to your student loans. And that's kind of the idea behind this provision. So how it will work, and this is something that a plan does not have to offer. So it's something that plans or companies will be able to elect as an option if they so choose. But if a participant or an employee makes a qualified student loan payment, which that's pretty broadly defined right now, they can receive match money from the company as if they had paid into the 401k plan instead. That's an annual certification requirement. The employee has to show some sort of proof or certify the amount of the payments that they made throughout the year to receive that benefit. But it is a very unique provision. We've never really seen anything like it. And of course, with any kind of change like this, there's always the chance that employees who just got done paying off their student loans are going to be in a little bit of an uproar if you add this provision to your plan. So we think it's definitely interesting, a little bit new, nothing like we've ever really seen in the industry before, but it is something that we're getting a lot of questions on. It is something that is still, in need of additional guidance, I think, for most plans to be able to proceed with adding it. And again, this will be a feature, not something that you have to add to the plan, but an option that you will have to add in 2024.
Yeah, and I'll just add briefly to that. Like Allyson said, this fits into the rubric of it's reasonable to assume that there is going to be some kind of grace period, some kind of additional guidance, some kind of extension of when you'd have to decide what and how to handle this, because it is different. It does require a different sort of administration, but people are asking about it and interested in it, and for good reason.
The Secure Act establishes the basis for the creation of emergency savings accounts. Now, this is different than what Jon was talking about earlier. So this is different from the emergency distribution, which would actually come directly out of an employee's 401k account. This is the creation of a completely separate emergency fund account, basically. It's something that you can actually set up automatic enrollment with employees. We can see certain industries really benefiting from this. We see employees coming and taking a lot of hardships in certain industries. This could be a way for them to have kind of a separate account that wouldn't be subject to some of the same stringent rules and taxes and penalties as some of the hardship rules. So they're linked to the plan, but not actually a part of the 401k plan, which is what makes it a little bit different than what Jon was talking about earlier. They're made after tax or post tax, so similar to Roth, they're not giving employees a tax benefit. The contribution is capped at $2,500. They can be treated as elective deferrals for matching, so that's almost similar to the student loan provision, just a little bit of a different way of looking at it, treating something different than an actual contribution as a contribution for the purposes of calculating that match. So that shows up in a couple of provisions throughout Secure 2.0. And then the first 4 withdrawals that someone would make, there's no fees as a result of those. A 401k provider would not be allowed to charge a fee to process those distributions. And again, I mentioned this earlier, it's actually a plan or a company can elect to automatically enroll their employees with an opt-out provision. Of course, there's always that feature in an automatic enrollment arrangement, but at 3% or less of salary going into that emergency savings account. So that's something, again, that's also kind of completely new as a part of Secure 2.0. And lastly, and this we've also been getting a lot of questions on, so starting in, well, it was going to be 2024, now actually to the point, since we put these slides all together and started looking at the guidance, this provision has actually gotten bumped to 2025. So we were pretty sure that this one was going to be set in stone for 2024, and even that changed. But what this looks like is right now there is an under 50 limit for what employees can contribute to a 401k plan. And then anyone over 50 can contribute an additional amount called a catch-up contribution. So those amounts change each year based on inflation. They're announced usually in October of each year. Starting in 2025 now, employees who earn more than $145,000 in the prior year, so it'll be anyone who earned more than $145,000 in 2024, if they want to make catch-up contributions, those will have to go into a Roth 401k account. So previously, as an example, this year, an employee over 50 could contribute up to $30,000 pre-tax, so they could get a tax savings of up to $30,000 into the 401k. If this provision was active for this year with the current limits, anyone over 50 who makes over 145,000 could only get a maximum of a $22,500 tax deduction, because the rest of it would have to go into Roth. So you get the benefit of the savings, the investment, the future growth of the account. But ultimately, those who make over a certain amount are getting less of a tax benefit in the current year. And that is going to index up as well. For those of you who are familiar, and I'm not going to get into the weeds with this, but with annual non-discrimination testing on 401k plans, there is a distinction for certain employees called highly compensated employees, and that's a dollar amount that does change on an annual basis as well. I think it's very interesting to note that this is a completely different dollar amount, and they did not link the two. Why they did not link the two, I will never understand. It's just another thing for all of us to track, but just so that you know, that is a different number. So we're now having to track those two things separately. But again, this is actually effective for 2025, not 2024. We're not sure how it's going to work with the payroll software and record keeping software, and that is one of the major reasons for the bump in the effective date. There's still a lot to work out there.
Yeah, and just to touch on the guidance a little bit more, it was actually issued August 23rd. So these things are coming fast and furious, and it does allow for a transition period, a grace period. And it also signaled future guidance. Speaking to Allyson's point of implementation, it signals there's going to be and it's essentially all of this is done without amending the language of the law. And it's designed to give, I think it's fair to say, everyone in the industry a little bit of a break and more time to implement this sort of significant change. And keeping on catch-up contributions for a moment, and I'll note that super duper catch-up contributions is our term. That's not actually in the legislation, but it seems sort of catchy, so we went with it. And this item is effective in 2025, at least as of right now. And it comes from section 109 of Secure 2.0. And it increases catch-up contributions for participants who are from 60 to 63 years old. And once this takes effect, participants in that age range are going to be able to make these super duper catch-up contributions in the amount of up to the greater of $10,000 or 50% more than the standard catch-up contribution in 2025. And these amounts are going to be indexed for inflation. And that's a big deal because that's those final years potentially leading up to retirement. And folks that are able to do it are really going to be able to juice their retirement plan savings in those last few years. And it's worth noting that today, the catch-up contribution allowed is $7,500. So in 2025, assuming this takes effect, then we're already going to be well beyond the $10,000 using the 50% more than the standard catch-up contribution calculation, because we're already there today. 50% more than $7,500 is already more than $10,000. So This is a significant change. It's a little bit of an unusual use of a limited age bracket, but it makes sense when you think about folks approaching retirement and potentially being able to really sock away some extra money in their plans before they do retire. The next one here is long-time part-time rules. And this can be a big deal in a lot of industries. And if you have any part-time employees at your practice, and we find that often veterinary practice do have some part-time employees, then you should definitely be in touch with your plan providers concerning this issue and this change. Some background: Secure 1.0, the law that predated Secure 2.0, it improved accessibility to 401k plans for what we call long-time part-time employees. Essentially required that plan sponsors, your practice, must offer plan eligibility, must allow eligibility after a part-time employee works 1,000 hours in 1 year, or after a part-time employee works at least 500 hours per year for 3 consecutive years. And what Secure 2.0 is doing is just shortening that eligibility timeline for long-time part-time employees to working 500 hours per year in 2 instead of 3 years. And this is going to be effective starting in 2025. We'll see, presumably. And if you have part-time employees, if you even have them from time to time, it's something worth raising and understanding how that might affect those folks' eligibility to participate in your plan.
And they do, maybe John mentioned this earlier, but I missed it. They're only requiring you to allow employees to put in their own dollars. So it does not impact the company contribution. This only applies to them being eligible to contribute to the plan themselves.
I didn't mention, and a great point. Okay, still in 2025, mandatory automatic enrollment. Now, this is one that it's fair to say we get a lot of questions about. So, and a lot of sort of anxious questions about. So right at the top, it's important to know that all plans that existed before Secure 2.0 was enacted are grandfathered and do not need to comply with this provision. In other words, if you had a plan in 2022, you don't need to incorporate automatic enrollment unless you choose to do so. And for you, it is, and it's always has been, an option. It's not a mandate. It's not a requirement. On the flip side, for any new plans that started after enactment of Secure 2.0, so essentially starting in 2023, we'll say, they must, beginning in 2025, automatically enroll participants at between 3 and 10% of salary, and thereafter increase the rate 1%, as you see on the screen, each year until at least 10%, but less than 15% of salary is being deferred. Now, even within that mandated required group, that new plan category, there are significant exceptions. So businesses with fewer than 10 employees are exempt. So if your practice is starting a plan this year or next year, and you have 6 employees, then this doesn't apply to you. You do not have to include mandatory automatic enrollment. New businesses less than 3 years old are exempt. If you started a brand new practice, let's say this year or next year, and you ramp up and you hire a bunch of employees, you still, for those years, you're exempt from this rule. And churches and governments are exempt. Now, that's not going to apply to anybody here. And those are categories, frankly, that often are entitled to some level of exemption, but they're exempt from this mandatory automatic enrollment rule. In addition, employees can opt out of automatic enrollment. In other words, it's mandatory for the business to automatically enroll, but employees can choose, hey, thanks for automatically enrolling me, but I don't want to do this. So employees will have at least 90 days after automatic enrollment to opt out. And if any amounts have been deferred, in other words, taken out of their salary and put into the plan, they can take a distribution of that amount and get the money back, in other words. And this one, I think it's fair to say, is going to be a massive administrative burden for a number of businesses. Thus, we'll see. We don't know yet. No guidance on this that we've seen has been issued yet, but we would expect some guidance and potentially some relief and an extension of the deadlines and some kind of transition period to allow people to get up to speed in their plans, understand what this means, and apply it. And this would be particularly difficult, I think, for businesses that have turnover, that have significant turnover, because then you're automatically enrolling people. You might end up with small accounts that then you have to distribute. It does tie back a little bit to that increase in the unilateral distribution amount, but still, it's undoubtedly going to create some administrative burden. The positive, of course, is that it might get a lot of people into plans who might not do it themselves. In other words, it'll push people to be in the plan because that's the default. And as we know, inertia works wonders in a lot of things, and in retirement savings, chief among them, frankly.
So this is kind of a throwback provision because previous legislation removed the need for mandatory paper statements, and the Secure Act 2.0 is bringing it back. So the idea, and this really isn't going to impact you per se, this is going to impact your provider, whoever sends out those quarterly statements. But currently all statements can be provided electronically if a participant opts into receiving electronic statements. Starting in 2026, the idea is that at least one of those statements, so typically the last statement of the year, an annual statement, would need to be sent hard copy to a US mailing address. So we'll see, with how electronic distribution is going in general. We think this one could definitely be subject to change again, but still able to provide quarterly statements electronically, but we'll need to provide one mandatory paper statement annually. And then the Savers Match. So right now there is what's called the Savers Tax Credit. So certain lower income employees get a tax credit for what they contribute to the 401k account, and that comes back to them in the form of a refund if they, didn't overpay in taxes, or if they did overpay in taxes. What is going to happen starting in 2027, theoretically, is that instead of reporting this on their taxes and getting a credit and then refund, this would go directly into their 401k account instead. So it would be a match of 50% of contributions up to $2,000. It is a pre-tax contribution that goes in, so it would be taxable in the future, and again, subject to income limits. So for this to happen, there would have to be essentially an IRS or government link into every 401k provider's record-keeping software to be able to make that deposit. That's going to take a while based on our experience. So we'll see if this happens in 2027. I love the idea. What it does is then not only are they getting the benefits of their contribution, but they're getting future benefits too because of that investment component. So really it does benefit them in retirement more than the current tax credit does. But the logistics of how that's all going to work is very much up in the air. And I'm kind of excited, frankly, to see how it rolls out. But that will be available potentially in 2027.
And for what it's worth, I'll just add there that if you're watching the progression of these changes, I think it's fair to say that the law is reasonably well designed to put the more difficult, the more administratively difficult, the more burdensome changes further out in time. So here, like Allyson says, this is going to be a big deal and require a lot of work from a lot of parties, including plan sponsors, your veterinary practice, plan providers. And it's put sufficiently out in time, though, so that hopefully we can start to get our arms around it. And we might even get more time than this, it seems to me. So we're on the final slide, and I think we're doing reasonably well on time. The takeaway here is Secure 2.0 is big news and a big deal. It's going to have a lot of significant and long-lasting effects on 401k plans and other tax advantage retirement accounts. It's a massive piece of legislation. Today, we've sort of hit the tip of the iceberg. And what we think for you all, the most important thing to do is connect with your plan providers. See how they're handling these issues. Make sure you're comfortable with what they're doing. Or feel free to call us. We love to answer questions. As Allyson said at the top, we're into this stuff, which is strange to some people, but for us, it's what we like to do. So if you have questions, you're always welcome to just get in touch with us. I think we'll be able to distribute the PowerPoint to everyone, and it has our contact information in it. As you see at the bottom of the slide, these QR items, you can link to some additional 401k related articles and other wealth management related articles. And Allyson and I were on a podcast recently, so that was fun. And if you want to listen to it, if you can't get enough of this stuff too, give it a listen. I think it's interesting stuff.